Watching, I'm working more on my stock market project today after taking a couple days off. So I've basically run into a wall on the project with the current model I'm doing. So I'm going to go over the layout for the project, my goals for this project, the results with the current model, and why I'm going to try this new strategy. And then I have a slide to talk about the new strategy, and then I'll get into building it. And basically, what I'm going to be building up on this stream is the new strategy, and I want to see, how does this perform. So I'll get to that in a second. These are the goals, though, for the project. So the first goal is to beat the S&P 500 by a significant margin while staying market neutral. So the S&P goes up on average 6% per year. I want to do significantly better than that and return on average 18 to 24% per year. So 3 to 4 times the S&P. But I want to stay market neutral. So I don't want to ride the bull runs and bear markets. I want to get that 18 to 24% return regardless of if we're in a recession or in a big bull run. Now I'm writing all of this in Python, so I'm generalizing the code so that anyone can use this framework to create these sorts of models for themselves. So right now I'm creating a universe, creating a model, and implementing a portfolio strategy in about 100 lines of code. So if you're interested in that, check out the repository. The link's in the description. Download it, fork it, let me know how it works, let me know what features you'd like to see added, and of course, if you find it useful, please star the repository, watch the repository, and follow me on GitHub. So the first step is isolating a universe that the model's going to train on. So you don't want to use everything for a few reasons. The first reason is that different assets move differently. So common stocks like Apple or Tesla are going to move differently from ETFs, different price dynamics. Also, I want this to work on high volume stocks so that the strategy is scalable. Hopefully I can get funded by a quant shop or something like that. In order for that to happen, you need a strategy that scales to big amounts of money. So you need high volume. And I'm also trimming out penny stocks. So I have a stock universe that's working pretty well. I created a returns model. The goal for this is to predict returns relative to market or sector, Sharpe ratio, something like that. And then once I have a good returns model, which I do have a good model for the Sharpe ratio, but I'll get into that in a second. The final step is implementing this portfolio model. So what have I done so far? So like I said, I was training to predict the Sharpe ratio, and I was confident in my model for these reasons. So first off, if you look at the metrics, I'm beating my goal for every single metric here, highlighted in the red box. Also, if I look at the decile analysis, this looks perfect. The bottom decile is the worst performing, top decile is best performing, and it's monotonically increasing in between. So not only is it really good on the metrics, the decile analysis looks really good. And finally, when I did a walk forward analysis, trained a new model for every year, it never fell below my goal metrics. So for all of these reasons, I was confident in the model. I tried implementing some portfolio strategies on this model, and everything since 2023, since mid-23, it's really easy to implement portfolio strategies. But when I tried the same strategy on the walk forward, it failed from 2016 through 2022 and only did really well in the same region after mid-2023. So I went through and looked at lots of ways at improving this portfolio strategy. I tried using better models, and I did find something which works. So you see this portfolio strategy here basically does well from 2016 through 2020, loses a little bit of money in the COVID regime, but then does really well after that. So I thought I would go ahead with this model, but then when I looked at how does the model perform in 2026, it wasn't doing very well. So basically, this is just noise, chopped sideways. There's no real great performance in 2026. So before I start paper trading with this, I want to look through at a different strategy, which is this one right here. So instead of a single model that's trained to predict the Sharpe ratio, I'm going to use two models. I'm I'm going to have a model to predict the returns. That's going to tell me what stocks to use. And then I'm going to have another model that's predicting the volatility over the next 5 days. And that'll go into my hierarchical risk parity weighting of the stocks that I've selected. And then from that, I'll get the output of the portfolio strategy. So what I need for this is to train 2 returns models. So new models, returns. And then we want to know, does this perform better with features dropped out? Let's put a text box in. All features. Let's make it yellow. Give it a solid line. Okay, so let's pull up the code. Okay, so let's look at Model Explorer. Okay, now let's go to Feature Engine. Forward log return. Same as model 25. So what am I on now? 28? Yep. What is this, model 28? Okay, so let's try it with all features. Okay, so let's get that new model. New models, returns. So I need a new portfolio class. So what about last time I was doing returns without the Sharpe ratio? Yeah, this is really the problem. The lowest decile does better from 2016 through 2022. And then bottom decile does worst from 2022 through 2025. I mean, that doesn't look so bad. I really think just the returns might be good enough. So the walk forward looked bad in previous years. Okay, so here's the first one. Looks pretty bad. Over 2014. Hey, man. I'm good, thanks. Thank you. I hope things are going well for you. Things are going pretty good. I didn't do a stream there for several days because I kept hitting my head into the wall, but now I'm back at it trying this new strategy um, and hoping for the best. Correlations and a volatility model to allocate capital with an HRP strategy. Assess this strategy. What are the best practices to use when implementing this? Okay, here's the next one. That doesn't look very good either. 2015. That looks like just noise. Two different models with two different difficulty profiles. Goals for the volatility model. Information coefficient 0.2. Yeah, none of these are looking very good. Okay, I'm gonna go to the bathroom really quick. I'll be right back. Alright, so this one, what are we on now? 2017? So 2017 it starts to turn around. Wait, what happened? Uh-oh. Gotta run that again. It quit for some reason. Aleatoric. I've never heard that word before. Yeah, this is pretty inconsistent because now 2014 looks fairly different. It's not negative at the top decile anymore. But that's kind of odd. What? Oh. So that's a little bit different, but not better. Train 3 models, one targeting the 10th, 50th, and 90th percentile. The spread between the 90th and 10th predictions is your uncertainty proxy. Conformal prediction. This one looks not terrible. So what is this, 2016? Information coefficient is above 0.01. Does look better than 2016 here. I mean, I didn't change what I have turned on, did I? No, model 28. That's this one, right? Yeah. Incorporated. Oh, incorporated. Incorporated in HRP weighting serve as a proxy for the model uncertainty. CSC score. Okay, this guy's almost done. Let's see how it does. So information coefficient barely above 0. Doesn't really look terrible. This cumulative long-short spread didn't matter before. But now, because the target was the Sharpe ratio, so this is the long-short spread off the Sharpe ratio, but now it's the long-short spread off the log returns. So it actually would be the returns. So that's not terrible. This would be going long on the top 10%, short on the bottom 10%. So that would have done pretty well. $2017. So it actually looks significantly worse here. So 2018, then we'll have 5 here. So 19, 20, 21, 22, 23. Then we'll need to put in 24, 25, 26. Oh. So what am I training through? Walk forward. So yeah, this might go through to we'll have to see if it goes through to 2026 or not. Okay, so if we're going 2014 through 2023 is 10, 24, 11, 25 is 12. 13 models basically we're training. So we're, what, maybe close to a third of the way through? But this is just going to take a long time. Okay, so my plan for today, train this model, this plane model at left, then train it again with the, keeping only the most important features, and then seeing which one's better. Same thing for a volatility model. Once I have both of these, incorporate the two of them into a simple HRP strategy, which uses the volatility model instead of market volatility. And then I'll have this here, and then I'll see how this performs. So that's my goal for this stream. What are we at? So this is indeed on 2018, yeah. So let's see how it does. And I'm gonna go make some oatmeal real quick, because I'm hungry. It's, what, almost 11 a.m. Yeah, and I haven't eaten. So anyway, I'll be right back. I'm just gonna go microwave some oatmeal. Okay, so at least the lowest decile did the worst here, but then it's kind of the opposite of what we want above that. The returns look good though. Yeah, information coefficient's barely above 0 again. So that's not good. Let's see how 2019 looks. Hmm. Good. This is about to finish. So that actually looks pretty good. Pretty good in 2019. .01. So yeah, good. Wait, 2019, right? Yeah, so now it's doing 2020. Okay, so might not even be worthwhile training a volatility model. Whoa. 2020. Ah. 2020 it did really well. .0246. That's it's kind of odd. I wasn't expecting that. Here, buddy. .2020 never looks good. Oh, it looks good there. Does well sometimes. Alright, so 2020's done well sometimes. Oh, that's what I should look at. Model 22 or 21? Yeah, model 21. I guess I don't have model 21. Okay, so let's prepare the next model. So, model 29. That looks okay. It looks not bad until the top decile. But the cumulative spread is good. The information coefficient is really high. What's wrong there, buddy? What's wrong? What's the magnitude? 0.15. Did it finish yet? It's only at trial 30. Alright, so now I have 2, 3, 4, 5, 6. So 5 left. So 8 done, 5 left. This actually honestly doesn't look so bad. Alright, so this is all model 29. Then do features and target. Okay, universe path, same, target, features, folder path. Consistent calls. Model 29, walk forward. Whoa. 2022 looks really good. Wow. Information coefficient 0.03. Wow. 20. Is that perfect? Yeah. That's a. Now I'm not sure if for it to be perfect it has to if in order for it to be perfect it also has to you know, 0 should be in the middle. Because I kind of think maybe, but if your only rules are bottom decile lowest, top decile highest, each decile higher than the previous, then that satisfies both of those. So we just have 3, 4, 5, and 6 left. 4 left. Yeah, this looks all good. We just need this guy to finish running, but yeah, maybe I never actually did a full walk forward test on the returns only predictions, so maybe I could just implement this. But the nice thing is that the problem right now is training the models computationally expensive, and the only thing I have left to do is train another model. But then once this finishes training, I can train the next model, which is computationally expensive. But then I could just do a bunch of the portfolio stuff, and we could basically, while this model is generating, we can go through and look at how does how do the portfolio strategies work on this. So hopefully well, but we'll see. But anyway, let's see, where are we at? We're at close to the end, 40 trials and it finishes. So we're close to the end of 2023. 2022 is the best year yet for the model. 2021 and 2020 were both good years, which is odd. That wasn't the case on the Sharpe ratio model. So maybe, if I cut out the volatility from the Sharpe ratio, then it's not struggling anymore. I'm not sure. Here, it's about to finish, though. 'So it was, information coefficient was still good, but the decile analysis doesn't look as good. Four, five, six. So 3 out of 13 left. Twenty-four, 25, 26. Okay, I'm gonna go to the bathroom really quick. We're at trial 3, so 37 more trials and we'll be done. What are we at? 21? Oh, that was from April 11. For 5/17/2026. So, generate model 28, generate model 29, implement portfolio strategies for model 28, if applicable, implement portfolio strats for model 29. Is there anything else I want to do today? Let's see. What is the current logic? I guess I already asked. So let's see. Where's HRP? Variance enters exactly through diagonalization of the covariance matrix. Errors get dampened by the hierarchy. Single bad variance estimate for one stock only affects its weight within its terminal cluster and vary indirectly the cluster variance. That looks pretty good. What year is this again? '24, I guess that is. Wow, look at that information coefficient, 0.04. That's crazy, but that's what I got here too. I can't believe how good this is. Huh. This, I got a feeling this is the same thing. So let's see how it does on 2025. Man, this is taking a really long time. Why? Python not responding. Seems like it's running. Alright, so it's up to 32, not too far from being done. Whoa. That looks really good. So 2025 actually looks excellent. Let's see what the information coefficient is, because we were expecting that would be bad. 0.028, not bad at all. $20.25, really? So this now should be 26. Yeah. So there is enough data for it to train, so let's see how it does. Actually, this will be pretty interesting because the Sharpe ratio models looked pretty good over the whole time period, but in 2026, this is what the training region looked like. When I did increase the training region to go from the start of January, though, it looked better. So the question is, how does it look over this region? Basically, this is mid-February to end of April, so lots of the time, you know, it's the Iran war that's kind of an exceptional event. You know, the market's moving in kind of strange ways, but basically, if it looks bad like these do here, that's okay. The next step will be to check how does it look over January. But if it looks good, better than these, then I can be confident I have a good model here. What's 12-to-1 momentum mean? Low volume or volatility? Anomaly, accruals, asset growth, profitability. Ugh. It'll be interesting to see this too. $2025 might be one of the best looking years. Okay, we're like halfway there. I'm already using residualized returns. So, let's think. Yeah, once this finishes, we'll have lots of stuff to do. So I guess I could start making the portfolio. Let's make sure the next model's ready. So, consistent calls. Consistent calls. Yeah, I did all that already. 29, 29, 28. This is 28, right? Yep. So we're good here. Next, I'll do this. We'll start on model 29, and then we want to go to the portfolio explorer. Get walk forward. Hey NGK, Monster Coke is crazy. No, it's not printing money yet. It's actually a coffee. Monster coffee, but they're basically out now. Monster coffee, mint gum. Yeah, I like the flavor combo, to be honest. No, it's not printing money yet, but I'm working on different stuff. I'm going back. So I've been doing a Sharpe ratio target. Look, here's a good summary of my problem. Um, so earlier the whole thing was about getting like a good portfolio strategy to work well on early years, and it seemed like to work really well since the middle of 2023. So if I looked at how does each decile perform, basically 2016 to 2019 top one, and middle one 2020 basically COVID. Um, the bottom decile is way outperforming the top decile. It's like inverse of what it should be. And then 2022 to 2025, it's performing right on. So that's a bit confusing because the information coefficient is still high. But the I think one core thing is I'm predicting Sharpe ratio and not returns. Um, and so Sharpe ratio is a bit easier to predict. And so now, earlier I decided not to look at returns because it wasn't getting information coefficients really high for every year. But now that I'm looking at it, this looks bad on early years, but once it gets a good amount of training data, it seems like it's not doing, too terribly. So I think basically, whoa. Wow. Well, okay. Maybe this is also. Look at this. This is exactly the opposite of what you would want to see. So, I don't know. So, yeah. Again, the same thing completely fails on 2026. I don't know. So this is good. Model 29. on, let's run it. I'll be right back. I'm going to get a snack. Oh, hi, buddy. Okay. So let's get the portfolio now. Get model data. It looks better. So maybe it'll do better. What's the coefficient of variation? Or the, sorry, information coefficient, 0.01. Worse. Well, alright. We'll see, though. We'll see, buddy. I'm gonna go grab another snack pack. Well, that one looks really bad. Hey, sorry, buddy. I didn't see you there. Hey, Hike. How are you? Okay, so once we have the portfolio, it'll be here. What's up, buddy? I don't have anything more. What, buddy? So 2018 looks a little bit better. What's up? Good boy. What? What? Hey. Hey, almost done. Alright, well. Let's see how it does. Come on. Hey, Dwanit Panchal. How are you? What are you up to? Yes, I have, but I found it mostly was a pain in the ass. I couldn't get it to work with ease, and that's not really my bottleneck right now, is, coding fast. Hey, 2019 looks really good. Eating, what are you eating? Something good? Dinner? You have problems with training? Well, that is like the hardest thing is, the training and testing and getting the training to work, getting the testing to work, and making sure there's no biases. For some reason, I kept getting 0 movement because it plays too safe. Oh, well, that's not the worst problem to have. This actually looks really good, though. Simple volatility scaling, we get a sharp 1.28, so not great. Annual return 30%. Max drawdown 370 days. So some event would have killed it in late 2017. What about max effective? Yeah, 3 effective longs. What about rolling information coefficient? So what if we scale it down and it goes below minus 0.02? So set spread scaling. Oh no. Oh, well. So what's some spread? 0.1 to 0.04. Yeah, I'm gonna use information coefficient. So let's say reduce exposure if information coefficient is below minus 0.02. Below minus 0.01, maybe? What in the world is that? Oh, so this is 2020. That makes sense though, because that was a troublesome year. So this I actually trust more. That it struggled in 2020. That's probably a good indication, actually. This is kind of a question. Why did it do well in 2020? Watermelon, nice. One of the best meals you can have, in my opinion. Do you like to eat it as a big bowl? That's what I like to do. That makes it taste better, I think. Wait, hold up. This is, the returns are huge here. Oh, nice. That sounds good. I wish I had a nice big watermelon. I might go get some at the store after the stream. Well, I don't know what to make of this one. kind of the same profile, but it does look better here. So this is good, just plain old returns. Training on returns seems to do not too bad, but if I'm scaling, I guess the volatility is going up with time. So yeah, what if I just add information coefficient? Hey Peter, thanks. Hopefully I can have something going at some point that will make money reliably. My dream is to just run a script and have it, ideally I could plug it into some brokerage, run a script, zoop, 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 update portfolio positions, leave, and it gets me reliable 20% returns per year. Pi has good charting libraries too. Just a little... Wait, what? Oh, I guess my chat was behind. Python, I just so when I was using sort of like Google AI Studio to make web apps before. But then the problem is I just wasn't confident that it was, avoiding look ahead bias, correctly sectioning data between training, validation. You need to purge the data set. You need to find a data source that's including things that have been dropped out of the market. And basically, if all of this is happening under the hood, and I haven't coded it myself, then I'm not confident really in any of this. And so I feel like I felt like really to be confident in it, I need to make the code myself, set up the pipeline myself. And now that I have it set up, it's really easy. It's just changing a few things here and there to run different things. So I really don't see a reason for a web app. Man, look at this again. So okay, volatility drawdown's barely happening now. Information coefficient drawdown's dominating. This is interesting though. Look at this. So what is this? 2022? That looks really good, but so does, it also looks really good at left. So both look really good. It's hard to say that's an improvement though. 0.04, 0.04 minus 0.1. Yeah. Roughly similar scales. Is from AP Computer Science. That's not really crazy. That's when all the When is all the day trading gurus got crazy? um, so the drawdown is too severe, so I can tolerate higher volatility. What about the duration? Ooh, that's a long duration. 0.1, 0.2. Let's say we'll target 0.2 for volatility. Use IC scaling. What a stronger threshold. Alright, let's see if we get some balance scaling or not. Make sure this is saved. If you like coding, you need to find some project to work on. And then work on it regularly. And then you'll get really good at coding from that. That's really the best way to get good. Alright. Oh, well, what are you doing? What's your project, man? Is the project the one you talked about earlier? The stock market project where it's too conservative? You just have to tweak the parameters. Make it make it less conservative. Make it less conservative. It's a kind of a tongue twister. Alright, this should finish up soon. So, we do get a good balance. Spread's not factoring in too much. Your teacher didn't teach you jack. That's funny. You're doing the same project I'm doing? You're trying to get a good stock market model? How's it going? What are you using? Light gradient boosting method? Or something else? Told the Google AI Studio to tell me how to fix the zero problem like a week ago, and it was it was saying something, it was adding the sign. What does that mean? It was adding a sign function? It was trying to simulate some data, I guess? It must have been simulating data. I mean, you never could trust AI, could you? Or at least I never felt like I could. So what's today? The 17th? Okay, I'm gonna be right back. I'm going to the bathroom. I can't even trust AI. I can't say I have had so many. I can't tell which ones works anymore. I mean, you can't trust them, but you can use them. Um, no, I don't know. It's not so bad, is it? And anyway, those data centers have become so controversial. Um, it's very interesting the questions we're facing. It's like all the interesting questions people thought of like a long time ago. Like in the early 1900s, Orwell and all those guys. They're completely new concerns now. So this one's not far from being done. 24, 25, 26. Hey, Amit. Oh, yeah, sure. Let me, I mean, I'm not too busy right now. I'm just running stuff. So let me set this up to run and go look at Discord. I haven't been looking at Discord too much. I've gotten very busy with work. I just have been quite busy with work recently, but every time I think I'm gonna get a nice break, I don't. Oh, is the... Oh. So this is 2024. Looks pretty good. What's the IC? Whoa, 0.04? Wow. Oh, I guess it was good here too, though. Everyone, it's good in 2024. Okay, running. Alright, let's go see Discord. Okay, yeah. What is your username? Are you Jinx? That's cool. That's a good plan. Follow your dream of learning Python from scratch. I like that. I support it. Yeah, I'll send you a message after the stream. Oh, I already did. Alright, so just simple... What did I do there? I ramped up the volatility requirement. But you know, the exposure stays pretty low the whole time. Oh, but that did lower the max drawdown. Yeah, I will. I'll send you a message on Discord. So 371 days. Maybe we can look back 3 months. Hey, that looks really good for, what is this, 25? Wow. Yeah, 25 is really good. How big do you keep your batches for training? I'm not sure what you mean by that. How big of a data set do I train on? I'm training on all previous data. Um, and using different number of validation years, but like here I'm validating on 1 year. So if it's testing on 25, it's validating on 24, and then it's training from 2011 through 2023. And then there's some data embargo, so it really goes up till not all the way to the end of 2023, like maybe September 2023, like, June 2011 through September 23. It's training on, but it's training on the max data available to it once you account for the test and validation years. So how many lines does that end up being? For recent years, which are using like lots of data, it's over 1 million lines of data. But that's because for each asset there's an entry for each day. So that's a lot. Quickly turns into a lot of lines of data. So this looked good in 2025 too. But here's the real test, 26. .12. Let's do that again. Did I turn? Yeah. I have another simple Python thing I made. Claude code up, which I open once a week, which grabs data from like 500 tickers. Oh. Well, oh yeah, that's what this, it's at the end of the walk forward, so it's, on 2026. But, oh, you should try checking out yeah, this looks bad again. You should try checking out the data link in the description, because that includes all data going back to 2011, and it's there's no survivorship bias, so it even includes all things that have been dropped out of the market. So Yeah, there's definitely more volatility after COVID. Look at this, the dispersion of my universe, you can see obviously increased after COVID too. Right here. Boom, COVID, boom. Automatically a different dispersion regime. And then there's also the thing with all that other stuff. What's life changing? Alright, what were the settings I had? So there, a 60-day look back with target of 0.12. Did I put that in? Yep. So not too different. This one's a bit more extreme, I think. Yeah, I'm not sure that's so much better. Oh, the data. Oh, yeah, good. Good. I'm happy you find it useful. Yeah, I can't believe, honestly, that that's a free data source. Um, I hope as many people use it as possible. Yeah, I know what you mean. That's like one of the main challenges is finding good free data. So, good, yeah, leave that guy a star or however it works on whatever, however you make a repository look good, I forget. But do that for him because that is very valuable data for us. Um, all right, so that model's finished. I'm not sure. Um, Actually, the only real conclusion to draw from this. Yeah, the drawdown was worse. What was the time period? Yeah, magnitude was worse, duration was worse. So here it runs up to max exposure. It doesn't tell me when in 2020. So here let's just say 60-day rolling information coefficient. That's what we're plotting when it falls below minus 0.02. Do that. Volatility look back 20 days, but let's tolerate a lot more volatility. That shouldn't be doing a lot of the work. Let's see how it does. And the other model's not oh, Kaggle. Kaggle has some good stuff, but yeah, that's just it. Is everything's disjointed, patchy. It's always like a piece of a data set, never like the full data set. Okay, so actually the portfolio strategies don't look that bad on the returns model. Um, there must be some way to make it more stable. Oh, it was still false. So that's just tolerating higher volatility. So we got a bigger drawdown, of course. Um, and it might just be, yeah, I don't know. I can now forecast up to 60 minutes on any ticker of my choice. So what are you using? Minute data or second data? Or do they have like 30 seconds or something like that? What kind of data are you using? All right, so that long draw. So yeah, the way I'm doing the drawdown formulation, it's just penalizing it too much. And the information coefficient is still too low of a threshold, coming in too often. So let's move this back down to 0.04. Drawdown. Let's go to the portfolio scripts. HRP backtest. Should be that one, right? Yeah. If current drawdown is less than or equal to, so current drawdown, total NAV divided by rolling peak. So rolling peak should just be going off 30 days. Could do half a year. Needs to be more responsive, so let's make it 3 months. and do the same thing. All right, let's look at that. Market simulator. But so what kind of data are you using to make the predictions? What data goes into the predictions? Alright, this should be done soon. Ooh, did I save this? Well, we'll know if this doesn't look much different. If the drawdown scaling isn't any different, then we'll know that's the problem. Alright, here we go. So the drawdown's a bit more responsive. So the information, I don't understand this information coefficient scaling. Spread scaling. So what if I use spread scaling instead? Or what if I just permit a very low volatility? Wow, 1 minute data going back to 2008. Where'd you get that? Send it in the Discord if you don't mind. I'd like to look at that data. That'd be nice to have. Alright, just using very low volatility. And we'll see how that does. But, anyway, I think that's going to be it for now. I might do another stream later tonight. But thanks for watching. Don't forget to subscribe if you find this interesting. Have a good rest of your day. Adios. Strategy.